This is a silver eagle, 1 ounce of .999 fine silver, struck by the United States Mint, legal tender of the United States of America, with a face value of $1. For 40 years, this coin has been the benchmark for physical silver investment, the most liquid, most recognized, most traded silver product in the world. Yesterday, the spot price of silver closed at $92.47 per ounce, the highest price in recorded history, higher than the Hunt brothers' squeeze in 1980. Higher than the 2011 post-financial crisis peak, a number that seemed impossible 2 years ago when silver was trading at $22 and analysts were debating whether it could hold $25. But here's what's strange. Yesterday's spot price was $92.47. The price I paid this morning for a silver eagle at my local dealer was $137. $45 over spot. A 49% premium to buy physical silver that is supposedly available, supposedly liquid, supposedly easy to acquire. A premium that tells you the spot price, the number you see on your screen, the number the financial media quotes, the number that futures contracts settle against, has become a fiction. A paper abstraction disconnected from the physical reality of what silver actually costs when you try to buy it. The $92 breakout is real. The $45 premium is real. The question now isn't whether silver has broken out. The question is what happens when the paper market that shows $92 finally reconciles with the physical market that's already pricing $137. That reconciliation is $150 silver, maybe higher. And the mechanics that will drive it are already in motion. Here's what they're not telling you. Silver's move from $22 to $92 wasn't a speculative mania. It wasn't retail traders piling into a meme asset. It wasn't hedge funds running a momentum play. It was the systematic failure of paper supply to deliver physical metal. A failure that's been building for 3 years and is now reaching its breaking point. The silver market operates on a fractional reserve system that most investors don't understand. For every ounce of physical silver that exists in exchange warehouses, there are between 300 and 400 ounces of paper claims, futures contracts, ETF shares, unallocated accounts, forward agreements. The system works as long as most claim holders never demand delivery. They trade the paper, pocket the profits or losses, and roll their positions forward. The physical silver sits untouched while the paper changes hands. But when claim holders start demanding delivery, when they want the actual metal, not the paper promise, the fractional system faces a test it was never designed to pass. In January 2025, something changed. The COMEX, the primary exchange for silver futures trading, reported standing delivery notices of 47.3 million ounces. That's physical delivery demands, not paper settlements. In February, 52.1 million ounces. In March, 58.7 million ounces. Month after month, delivery demands increasing, each month setting a new record. By December 2025, standing delivery notices had reached 89.4 million ounces in a single month. The COMEX registered inventory, the silver actually available for delivery, was 112 million ounces. Do the math. At December's delivery rate, the entire COMEX inventory depletes in 5 weeks. The paper claims that supposedly represent silver ownership are demanding metal that will shortly not exist to deliver. The exchanges have responded the only way they can, by making delivery harder. Margin requirements have increased 340% since January 2025. Position limits have been reduced. Settlement rules have been modified to allow cash settlement where physical settlement was previously required. The COMEX isn't facilitating price discovery anymore. It's managing an orderly retreat from a system that cannot honor its obligations. This is where the lie becomes unsustainable. The $92 spot price isn't a market price. It's the price at which paper trades. The physical market, dealers, refiners, mints, industrial users, is trading at a completely different price. The premium is the gap between fiction and reality. At 7:30 a.m. Eastern this morning, I surveyed prices at 12 major silver dealers across 3 continents. APMEX, the largest online retailer in the United States, Silver Eagles at $141.47. That's $49 over spot. JM Bullion, $138.92. Premium of $46.45. SD Bullion, $136.88. Premium of $44.41. Kitco, the Canadian dealer, $139.50 Canadian daler, which translates to $142 USD at current exchange rates. Premium of $50. European dealers show similar patterns. CoinInvest in Germany, 128 euros for a maple leaf, equivalent to $139 USD. Bullion by Post in the UK, 108 pounds, equivalent to $137 USD. The premiums aren't isolated to one dealer or one product. They're universal. Every form of physical silver, Eagles, Maples, Britannias, Philharmonics, generic rounds, 10-ounce bars, 100-ounce bars, 1,000-ounce industrial bars, trades at massive premiums to spot. The premiums are largest for retail products and smallest for industrial bars, but even 1,000-ounce bars are trading at $12 to $15 over spot when they typically trade at 50 cents over. When the entire physical market diverges from spot by 20 to 50%, the spot prices become meaningless. It's a number generated by paper trading that no longer reflects the cost of acquiring metal. The real price of silver isn't $92. It's $137 for retail investors and $105 for industrial buyers. Those are the prices where transactions actually clear. At some point, the paper market must recognize the physical market. Futures contracts that can't deliver metal must price that failure. ETFs that claim to hold silver must explain why their shares trade at discounts to the metal they supposedly own. The reconciliation will be violent, because the gap is now so wide that closing it requires a move of $30 to $50 in spot prices. $150 isn't a prediction. It's the current physical price, laundered through the premium, waiting for the spot market to acknowledge it. When delivery failures cascade, premiums compress by spot rising, not by physical falling. The historical precedent is clear. Every time physical premiums have spiked in precious metals markets, the resolution has come through spot prices rising to meet physical prices. Physical prices don't fall to meet spot. The paper market capitulates to physical reality. In 2008, during the financial crisis, silver premiums spiked to $6 over spot when spot was $9. Within 18 months, spot had risen to $48. The premium compressed not because physical got cheaper, but because spot caught up. In 2020, during the pandemic, premiums spiked to $8 over spot when spot was $12. Within a year, spot had risen to $30. Same pattern. Paper capitulates to physical. Today's premium is $45, when spot is $92. The compression implied by historical patterns suggests spot rising to $130 to $150 to meet physical prices. The pattern has repeated in every silver market dislocation for the past 50 years. There's no reason to believe this time is different, and significant reason to believe this time is more severe. The delivery demands hitting COMEX aren't retail investors buying silver eagles. They're industrial users, solar panel manufacturers, electronics companies, medical device makers, who need physical silver for production and can't substitute paper contracts for actual metal. At 11:15 a.m. Beijing time on Thursday, LONGi Green Energy, the world's largest solar panel manufacturer, announced that it had secured a 2-year silver supply agreement with a major refiner at prices substantially above current benchmark quotations. The company declined to specify the price, but analysts estimate the contract was struck at $115–120 per ounce, 20 to 30% above spot. LONGi isn't paying premium out of charity. They're paying premium because they can't run their factories without silver, and they can't get silver at spot prices. When the largest industrial consumer in the market starts paying 25% premiums for locked-in supply, they're telling you what they think silver is actually worth. Less than 30 days remain before the March COMEX delivery period opens. Open interest in the March contract is currently 847 million ounces. Paper claims against 112 million ounces of registered inventory. If even 15% of open interest stands for delivery, the COMEX faces demands for 127 million ounces against 112 million available. The math doesn't work. The exchange will manage the failure through some combination of cash settlement, position limits, and rule changes. They've done it before. But each managed failure further erodes confidence in paper silver as a claim on physical metal. Each failure pushes more participants to demand delivery before inventory runs out. Each failure accelerates the transition from paper pricing to physical pricing. While one side sells paper, the other side buys metal. The entities that understand silver's supply-demand fundamentals aren't trading futures. They're accumulating physical metal and removing it from the deliverable supply. Chinese silver imports have increased 67% year over year. The metal is flowing into Shanghai and disappearing into strategic reserves, industrial consumption, and private hoarding. Every ounce that enters China is an ounce that won't return to Western markets to satisfy delivery demands. India's silver import set a record in 2025, 329 million ounces, up from 244 million in 2024. Indian demand is cultural, monetary, and industrial combined. The silver flowing into India isn't for trading, it's for keeping. Jewelry, religious artifacts, family savings, forms of holding that don't return to the market for generations. At 4:45 a.m. Eastern on Friday, the Silver Institute released preliminary 2025 supply-demand data. Total supply? 1.01 billion ounces, including mining, recycling, and inventory drawdowns. Total demand? 1.24 billion ounces, including industrial, investment, jewelry, and silverware. Deficit? 230 million ounces, the fourth consecutive annual deficit, the largest deficit on record. The silver market has been in deficit for 4 years. That deficit has been filled by drawing down above-ground inventories, ETF holdings, COMEX stocks, LBMA vaults. Those inventories are finite. At current deficit rates, they exhaust within 18 months. When they exhaust, the paper claims that assumed metal availability must reconcile with metal that doesn't exist. $150 silver isn't a prediction about speculation or momentum or technical breakouts. It's a prediction about arithmetic. Demand exceeds supply by 230 million ounces annually. Inventories are depleting to fill the gap. When inventories reach zero, price becomes the rationing mechanism. The price that rations 230 million ounces of excess demand isn't $92. It's whatever price destroys that demand. And industrial demand destruction for silver occurs at much higher prices than investment demand destruction. Solar panel manufacturers can't substitute away from silver. The element's conductivity is irreplaceable in photovoltaic cells. Medical device manufacturers can't substitute away from silver. Its antimicrobial properties are essential for surgical instruments and wound care. Electronics manufacturers have limited substitution options. Silver's conductivity exceeds copper by 6%, and its reliability in contacts and switches is unmatched. Industrial users will pay $150. They'll pay $200. They'll pay whatever they must to secure supply for production lines that can't run without it. The demand destruction that balances the market comes from investment demand, from jewelry, from applications where silver is optional rather than essential. That destruction requires prices high enough to make discretionary buyers exit the market while essential buyers remain. Some will look at $92 silver and see a bubble. We'll remember the Hunt brothers. We'll assume that what rises this fast must fall. We'll trust that paper prices reflect reality and premiums are temporary distortions. These are the same voices that said $50 silver in 2011 was a bubble, then watched spot fall to $14 while industrial demand kept growing. They were right about the price. They were wrong about the fundamentals. The deficit that existed in 2011 has grown every year since. The industrial demand that justified $50 then is 70% higher now. The supply response that was supposed to materialize at high prices never arrived because silver mining is primarily a byproduct of copper, lead, and zinc production that doesn't respond to silver price signals. Others will calculate the deficit. We'll track the inventory drawdowns. We'll notice that physical premiums are $45 when they were $3 2 years ago. We'll understand that a 49% premium to buy metal means the paper price has become disconnected from physical availability. The informed are not predicting that silver will hit $150 on any specific date. Commodity markets are too volatile for precise timing. What the informed recognize is that the gap between paper and physical prices must close, that historical precedent shows spot rising to physical rather than physical falling to spot, and that a 230 million ounce annual deficit cannot persist indefinitely against finite inventories. This is not financial advice. This is not a recommendation to buy silver or silver eagles or SLV shares or mining stocks. This is simply a description of arithmetic, the arithmetic of demand exceeding supply, of paper exceeding physical, of a market where the price on your screen no longer reflects the price at your dealer. $92.47 on COMEX, $137 at the coin shop, $115, $120 in industrial supply contracts. 3 different prices for the same metal. The spread between them, $45 in premiums, $25 in industrial contracts, represents the gap between paper fiction and physical reality. That gap will close. It always closes. And when it closes by spot rising to meet physical. $150 isn't a ceiling. It's where the paper market finally admits what the physical market has been saying for 2 years. Silver broke out. The premium confirms it. The deficit guarantees it. The only question is whether you understood what $45 over spot was telling you before the paper price caught up. Because once it catches up, the premium compresses, but the price doesn't fall. It just becomes the new floor.